I want you to try and visualize a number, 1.8 billion. It is a number so large that the human brain struggles to comprehend it. If you counted to 1.8 billion, one number per second, it would take you almost 60 years. Now I want you to imagine that number in ounces of silver, 1.8 billion ounces. That is the equivalent of nearly 2 full years of global mining production. Every mine in Mexico, every mine in Peru, every mine in China, Russia, and Australia, working 24 hours a day, 7 days a week, for 2 entire years, would just barely scrape together that much metal. It is a mountain of silver that would dwarf the pyramids. And yet, we are supposed to believe that this mountain of metal changed hands in a single trading session yesterday. We are supposed to believe that 1.8 billion ounces of physical silver were bought and sold, moved, vaulted, and settled in a 24-hour period. This is the lie, this is the illusion, and this is the crime scene that we are going to investigate today. Because what we witnessed yesterday was not a market functioning. It was not supply and demand discovering a fair price. It was a paper assault. It was a digital bombardment designed to do one thing and one thing only, to break your spirit, to make you look at the screen, see the volatility, and sell your position out of fear. They threw the kitchen sink at the market. They threw the entire contents of the COMEX warehouses multiplied by 10 at the price. And the most incredible part of this story is not the size of the attack, it is the result of the attack. Because after all that sound and fury, after all that paper selling, after 1.8 billion ounces of selling pressure, the price of silver is still standing. It is still trading above $115. It is still defending the breakout zone. They fired their biggest cannon and the wall didn't crumble. In fact, it barely scratched the paint. This is the signal. This is the moment where the tide turns. Because if they can't crash the market with a nuclear weapon of paper contracts, they have nothing left. They are out of ammo. And today, we are going to walk through the smoke and see exactly why this failed pump and dump is the most bullish signal we have seen in 50 years. We need to start by dissecting the mechanics of what they did because it was a classic pump and dump operation, but executed at a sovereign level. Early in the session, we saw the price run up. It looked beautiful. It looked like another breakout. This was the bait. They needed to pull in the momentum traders. They needed to get the retail public excited. They needed to get you to open your app and buy the high. Why? Because they needed liquidity. They needed someone to take the other side of the massive short position they were about to open. They baited the trap with greed, and once the longs were committed, they slammed the door. Suddenly, out of nowhere, massive sell orders hit the tape. Not hundreds of contracts, but thousands. In minutes, the price reversed. The green candles turned red. The euphoria turned to panic. This is the dump. The goal is to trigger a cascade of stop-loss orders. They know where your stops are. The algorithms know exactly the price point that will force the average trader to capitulate. They pushed the price down to that pain point, triggered the stops, and watched as the market sold off on its own momentum. It is a ruthless, efficient machine designed to transfer wealth from the emotional many to the calculating few. But here is where the script went wrong for them. In a normal blow-off top or a normal crash when the price drops, the open interest should collapse. Open interest is the total number of open futures contracts. When speculators get scared and sell, they close their positions and open interest goes down. It signifies that the energy is leaving the market. It signifies that the party is over. But that is not what happened yesterday. We looked at the data. We looked at the CME reports. And the open interest did not collapse. In fact, in some metrics, it actually went up. What does this mean? It is arguably the most critical data point of the week. It means that the longs did not fold. It means that for every short contract the banks threw at the market, someone stood there and bought it. Someone stood in the path of the avalanche and said, "I will take it." Who has the capital to absorb 1 billion ounces of paper selling without flinching? It isn't the guy on Reddit. It isn't the retail stacker buying a tube of Eagles. It is the smart money. It is the sovereign wealth funds. It is the industrial giants. It is the entities that know the paper game is ending, and they are using these liquidity events to accumulate massive positions without pushing the price to the moon yet. The fact that open interest remained high tells us that the tension in the spring has not been released. The shorts are still trapped. They threw 1 billion ounces at the market to try and break the price so they could cover their shorts cheaply, and it didn't work. Now they are sitting on an even bigger short position at a higher price, with a market that refuses to go down. This is the recipe for a short squeeze of biblical proportions. They have dug the hole deeper. They have doubled down on a losing hand. And when they are finally forced to cover, the buying pressure will be unlike anything we have ever seen. I want to talk about the psychological aspect of this because that is where the real war is being fought. It is not being fought on the charts. It is being fought in your mind. The purpose of volatility is to exhaust you. They want you to feel 3 specific emotions: envy, fear, and shame. First, they trigger envy by pushing the price up. You see it moving. You wish you had bought more. You feel like you're missing out. Then they trigger fear by smashing it down. You see your profits evaporate. You worry it's going to zero. You panic. Finally, they trigger shame. When you sell at the bottom and the price bounces back, you feel stupid. You feel like you were tricked. You feel like you aren't cut out for this. This cycle, envy, fear, shame, is a weapon. It is designed to separate you from your position. They know that if the price just went up in a straight line, nobody would ever sell. Everyone would just hold and get rich. So they have to create the roller coaster. They have to make the ride so nauseating that you beg to get off. They want you to look at your silver and see stress, not wealth. They want you to look at the chart and see danger, not opportunity. But you have to realize that this is a game. It is a psychological operation. The silver in your vault didn't change. It didn't get lighter. It didn't tarnish. The industrial demand for that silver didn't disappear because a chart in Chicago went down. The debt of the United States didn't decrease because a banker pressed a button. The reality is unchanged. Only the perception is being manipulated. If you can detach your emotions from the price action, you become immune to their weapon. You become unshakable. And an unshakable holder is the bullion bank's worst nightmare. Let's go back to the number, 1.8 billion ounces. I want to drill down on why this proves the market is broken. The global mining industry produces about 800 to 900 million ounces a year. That includes every scrap of silver that comes out of the ground as a byproduct of copper, gold, zinc, and lead. To trade 1.8 billion ounces in a day means we traded 2 years of supply. But where is that supply? It's not in the COMEX warehouses. The registered inventory there is barely enough to cover a fraction of that volume. It's not in London. It's not in Shanghai. It is paper silver. It is a promise. It is a contract that claims to represent silver, but has no backing in the physical world. It is fractional reserve banking applied to commodities. They are selling tickets to a show that has sold out 10 times over. As long as nobody asks for their seat, as long as nobody demands delivery, the scam continues. But the moment confidence breaks, the moment people say, "I don't want the ticket, I want the medal," the illusion collapses. And we are seeing signs that the illusion is starting to flicker. Look at the lease rates. In a normal market, if you want to borrow silver, it should be cheap. If there is plenty of supply, the interest rate to borrow it should be near zero. But lease rates are rising. They are elevated. This means that silver is scarce right now. It means that institutions are willing to pay a premium to get their hands on metal immediately. This is called backwardation. It is when the spot price is higher than the futures price, or when the cost to borrow suggests a shortage. Backwardation is the market screaming that there is a physical shortage. The paper market can trade billions of ounces, but the physical market deals in reality. If you need silver to build a missile or a solar panel or a medical device, you cannot use a paper contract. You need the metal. And the rising lease rates tell us that the metal is becoming harder and harder to find. The paper price can be manipulated, but the lease rate is a truth teller. It tells us that the cupboards are bare. We also have to look at the sticky premiums. Yesterday, when the price was getting hammered, did you see the premiums on Silver Eagles or Maples drop? Did you see dealers slashing their prices? No, the premiums stayed high. In some cases, they went up. This is a phenomenon we call decoupling. The spot price goes down, but the physical price stays up. This implies that the dealers know the truth. They know that if they sell their inventory cheap, they won't be able to replace it. They are not fooled by the paper smash. They are pricing their metal based on physical supply and demand, not on the whims of a high-frequency trading algorithm. When the spot price and the physical price diverge, follow the physical price. That is the real value. The spot price is just a derivative. It is a noise signal. So why did they do it? Why did they dump 1.8 billion ounces? Because they are desperate. You don't fire all your ammo if you are winning. You don't use your nuclear option if a skirmish will do. They are terrified of the price breaking out of control. They are terrified of silver crossing $120, $130, because at those levels, the math blows up. The derivatives complex, the trillions of dollars in bets tied to interest rates and commodities, starts to unravel. They are trying to defend a psychological line. They want to paint a double top on the chart. They want the technical analysts to look at it and say, oh, that looks bearish, I better sell. They are painting a picture, but the picture is a forgery. The underlying fundamentals, the deficit, the demand, the debt, are stronger than ever. I want to compare this to 2011. In 2011, when silver crashed from $50, it was a different world. The demand was speculative. People were buying because they thought the dollar would collapse, but the economy was still functioning normally. There was no green energy transition. There was no AI boom. The industrial floor wasn't there. When the speculators left, the price collapsed. Today is different. Today we have a hard floor of industrial demand. Solar panel manufacturers are not speculators. They are consumers. They need the metal to exist. If the price drops, they don't sell. They buy more. They back up the truck. This puts a safety net under the market that didn't exist in 1980 or 2011. The pump and dump might scare the tourists, but it doesn't scare the industry, and it shouldn't scare you. We are watching a battle between the old world and the new world. The old world is the world of paper assets, of fiat currency, of promises, of debt. It is a world where you can print prosperity. The new world is the world of tangible assets, of resources, of energy, of truth. It is a world where you can't fake it. Silver is the bridge between these two worlds. It is money, but it is also a commodity. It is the ultimate truth teller. The old world is fighting for its life. It is using every trick in the book to suppress the price of the new world assets, but they are fighting gravity. They are fighting geology. They are fighting math. Eventually, the math wins. Eventually, the paper dam breaks, and the river of reality floods the valley. We are standing on the high ground, watching the cracks in the dam get wider. Yesterday's volatility was the sound of the dam groaning under the pressure. So, what should you do? What is the actionable advice in the face of this madness? First, recognize the game. When you see a massive spike followed by a massive crash on no news, know that it is a manipulation. Do not react. Do not log into your account and panic sell. Step away from the screen. Go for a walk, read a book, do anything but give them your ounces. Second, watch the close. The intraday volatility is noise. The closing price is the signal. Yesterday, despite the attack, we closed above key support levels. The market defended the 115-hour area in the context of the recent range. The fact that we didn't crash back to $90 is a massive victory. It shows that the buyers are exhausted but not defeated. It shows that the sellers are desperate but ineffective. Third, look at the big picture. Zoom out. Look at the monthly chart. Look at the yearly chart. We are in a massive uptrend. A 5% or 10% correction in a bull market is not just normal. It is healthy. It shakes out the weak hands. It allows the market to refuel. It transfers the asset from people who are renting it to people who are owning it. You want to be an owner. Fourth, prepare for more. This is not over. If they threw 1.8 billion ounces yesterday, they might throw 2 billion tomorrow. The volatility will get worse before it gets better. We are entering the messy middle of the bull market. The easy gains are gone. Now comes the trench warfare. Now comes the battle for every dollar. You have to be mentally tough. You have to decide that you are not going to be shaken out. I want you to think about the Hunt brothers in 1980. They tried to corner the market, and the establishment changed the rules to crush them. They raised margins. They limited positions. They did everything to stop the price. Today, the Hunt brothers are not two guys from Texas. They are the people of India. They are the central bank of China. They are the solar industry. You cannot crush them with a margin hike. You cannot bankrupt a sovereign nation with a rule change. The forces driving silver today are bigger than the COMEX. They are bigger than the bullion banks. This time, the manipulation will fail because the buyers are too big to fail. We are also seeing the return of the vigilantes. In the bond market, the vigilantes punish governments for bad fiscal policy. In the silver market, the vigilantes are the physical buyers. They are punishing the paper market for its lies. Every time the paper price drops and the physical buying accelerates, the vigilantes are voting. They are voting against the dollar. They are voting against the debt. They are voting for sound money. The 1.8 billion ounce dump was a test. It was a stress test of the market's resolve. And the market passed. The patient is alive and kicking. In fact, the patient is stronger than ever. If that's the best punch they have, then they are in trouble. Because silver is getting up off the mat, wiping the blood from its lip and asking, "Is that all you got?" You need to have that same attitude. When the market punches you in the face, don't cower. Stand tall. Realize that the punch proves you are right. They wouldn't be attacking if they weren't afraid. They wouldn't be dumping 1.8 billion ounces if the price wasn't threatening to destroy their short positions. The violence of the attack is proof of the value of the asset. I want to talk about the concept of information asymmetry. The banks have more information than you. They see the order flow. They know the stop losses. But you have one advantage they don't have: time. They are on a clock. They have quarterly reports. They have margin calls. They have bonuses to worry about. You don't. You can hold your silver for 10 years, 20 years, forever. It costs you nothing to hold. It costs them everything to suppress. Use your advantage. Use time. Let them play their games in the short term. In the long term, the fundamentals will grind them into dust. The supply cliff is coming. The mines are running dry. The demand is exploding. Time is the enemy of the short seller and the friend of the stacker. We are also seeing a shift in the narrative. For years, silver was the devil's metal. It was volatile. It was risky. It was a pet rock. Now, slowly, the narrative is changing. People are starting to talk about it as a strategic asset. People are starting to talk about it as freedom money. When the narrative shifts, the money follows. We are still early in that shift. The herd has not arrived yet. The herd is still confused by the volatility. You are ahead of the herd. Stay there. The pump and dump of January 28, 2026 will go down in history as a turning point. It will be remembered as the day the paper tigers roared and the physical market didn't flinch. It will be remembered as the last stand of the shorts. So as we move forward into the rest of the week, keep your eyes on the prize. Don't look at the hourly chart. Look at the physical world. Look at the debt clock. Look at the solar fields. Nothing has changed except the desperation of the establishment. They are trying to shake the tree to see if any loose fruit falls. Don't be the loose fruit. Be the branch. Be the trunk. Be the roots. Hold on tight. The storm is here, but storms pass. And after the storm comes the rainbow. And at the end of this rainbow, there isn't a pot of gold. There is a stack of silver. And it is worth a hell of a lot more than $115. We are witnessing the death of a lie and the birth of a new reality. Birth is painful, it is messy, it is loud, but it is necessary. Don't let the labor pains scare you. The baby is coming. The new era of sound money is being born right in front of your eyes. 1.8 billion ounces. Remember that number. It is the measure of their fear. It is the measure of their deception. And ultimately, it will be the measure of their failure. Stand your ground. We are winning.